Hello everybody. So today I want to make a quick video about SoFi. SoFi is still growing like a weed. That was the name of a video I had made more than a year ago about SoFi, and it's still growing quite a bit. My position in SoFi is about 3%. I'm still holding. I have not added to SoFi in a long time because I think 3% is good enough for me in a neobank. I also have a large position in neobank. If you follow my portfolio, I have all of that stuff on Patreon. Anyways, another reason why really I kind of set it and forget it, tin can strategy for SoFi, put it in a tin can, forget it, look at it 20 years from now. Well, maybe not 20, but at least 10. That other reason is because I've been tired of a perpetual attack. I mean, this stock is attacked by the shorts all the time. If you look at the options on this stock, it's crazy. Like some days it's close to the Nvidia options. Everybody's attacking this stock. It's always trading in a range. It must be trendy for legacy finance to play and to short the newcomer on the block, is my view on this. And they may be especially inclined to do that when SoFi is very open about becoming a top 10 financial institutions, the one-stop shop for your finances, the AWS of banking. It probably makes a lot of people mad and they want to short it. And so I'm tired of trying to understand the market movements. To me, I agree with the strategy. I think they have a winning strategy. It's a neobank. I believe in neobanks. We don't need for Bank of America something like 8,000 branches. For JP Morgan Chase, it's 6,000 branches. Bank branches are like a pharmacy. They're gonna go the way of a dinosaur. They're not gonna be a thing, just like a physical pharmacy or a physical retail store. So I believe in the story. I'm in it for the long run. I was gonna put it in a tin can and look at it after 2030. But because it's true that a lot of you in the comment section ask me about SoFi, I figured I would cover SoFi very quickly today. But I'm not going to go into the deepest details here. First of all, I'm surprised, I'm not surprised. I knew it was growing, but 9.3 million outstanding. I mean, congrats, SoFi. You've been growing at 40% for the past 6 or 7 quarters, and now are we going to have 6 or 5 quarters of growth in the 30% quarter over quarter? I mean, it's outstanding that you're still growing at 35% from such a huge base. Remember JP Morgan. When I look at this number, it's 5 to 6 times cheaper, right? JP Morgan, America's biggest bank, don't they have about 50-ish million customers? So they're only half an order of magnitude bigger than SoFi. It's stunning, right? There used to be a time not too long ago, 2020, when JP Morgan was 50 times bigger. Now it's 5 times bigger. So this company is well on its way. If you have a Galileo account, I remember a few quarters back, I guess it was more than a year back, everybody was saying, oh, Galileo's dead, AWS of finance is not going to be a thing. Well, look, it's turned around. So they've done a good job. They've done a better job than StoneCo, which is another stock that I've published more on because nobody else covers StoneCo. I actually have a bigger position in SoFi now than in StoneCo, but nobody else covers StoneCo. But StoneCo they've had issues turning around their software division. Galileo, they've succeeded. I mean, I'm very happy to see that growth back. You see 20% in Q1, 23% in Q2, 17%. Some people are catching up on Galileo. Of course, they are lending products. There are other products. They are growing fast. This is a company that is asset light or on its way to becoming more asset light. They only lend to the most bankable borrowers, those Gen Z, younger millennial who make $150,000 a year. That's the target. And they've been doing a good job at underwriting. It's all about how you're going to get repaid when you do personal loans and things like that. You can see in 2017, for comparing a cohort, right, comparing the cohort from 2017 and the cohort from 22 to 23, so a 1-year span, you can see that at the same point in time, the 2017 cohort at a 4.77 cumulative loss versus a 3.3. So they've been doing a better job at underwriting. Must be pickier. And they likely are, right? We know in 2022, 2023, banks were very picky into who they lend. They must be pickier, but of course, the less you land, the less revenue you're going to get as a bank. Remember, banks can grow pretty much as fast as they want, provided they want to take unlimited risk. But banks don't want to take unlimited risk because they don't want to go bankrupt. So it's a double-edged sword. So anyways, let's keep looking at the other numbers. So the revenue is growing in Q3 23 to Q3 24. We had 30% growth. We were in the mid 20% over the past quarters. Q4 23 was 34%. So you can see the adjusted net revenue quarterly is growing. And of course, the short-sightedness of the market might have reacted poorly in Q1 and Q2 because you're looking at a flattish thing. But if you zoom out, the revenue is clearly growing. And really the other stellar part, which on that case, Wall Street is pretty happy about, is the adjusted EBITDA. Like I said, they've turned on profitability, scaled back the growth, scaled back the efforts, the sign-up bonuses, etc., just to show that profitability, to get some respect from Wall Street. If any evidence is to be believed, by the way, the stock reacts to the outstanding earnings they posted today. They're not getting that respect just yet. But that was the trend. That was the strategy of the 22, the 23. I would much rather see them make less money. Look at that EBITDA, 186 million. That's some meaningful money. I'd rather see them make less money and actually turn on the growth, invest in the growth. There's always this trade-off between how much money you're going to make and how much you're going to grow. They decide to achieve a balance, But anyways, that's just the way it is. The EBITDA is growing. The net income is growing. The revenues are growing. This is over a 12-month period when you compare over a full year period. So everything's good. I'm very happy to see all of that. And another thing here is when you look at the guidance. So let me zoom on the guidance. They have given us the guidance for 2024. So there's only one quarter remaining, but they're telling us the growth is going to be between 22 and 23%. Adjusted EBITDA is going to be stuck at 25%. That's excellent. And I don't discuss GAAP ever. This is not something I look at, right? It's accountants. They want to calculate earnings, how they calculate it. That's not what I want. I look at the economic value actually created. Tangible book value, I'll get to that in a second. That's relevant for banks. So let's go. So the revenue growth, and I'm going to try to answer the question here. How much am I paying for that growth? And I'm going to try to put SoFi through my spreadsheet, which, believe me, I don't think this spreadsheet is meant for banks. Banks, they have this clear relationship between how fast they grow and how much money they make. And when I made this spreadsheet, historically, I've always found it doesn't really work for a bank, but I'm going to do it anyways. So SoFi is growing at 22 to 23% year over year. That's the guide. Adjusted EBITDA is 25%. Gross margin, of course, it all depends how you calculate on a bank, and we can argue. But gross margin is 82%, and I'm using the Seeking Alpha number here. Point number one I'm going to make is the book value. So if you look at the price to book value, and banks are often valued on their book value, the price to book value, SoFi is a 1.89, JP Morgan is a 1.94. But SoFi grew its book value by 29%. I didn't see by how much JP Morgan grew its book value, but my gut feeling tells me it's probably way less than 25% growth in book value. So the idea is that if you're going to keep a constant ratio of price to book value, and if SoFi is able to grow the book value at 30% year after year after year, that may be another metric you can use to kind of see where the stock is headed. Not what I usually use, but that's common in the banking sector. Now, how much am I paying for that growth? That's what I do on this channel. I try to answer the question, each percentage point of future growth, how much am I paying for it? And I try to compare all of the stocks, right? I have more than 150 stocks that I compare. So, assuming they're going to do 23% in the next 12 months again, which I think they could do more. I think they are very likely to do more because the rates are going to drop. More people are going to want money because the rates drop. There's going to be more people refinancing their mortgages, refinancing their student loans. Demand for loan picks back up when rates drop. So I don't believe they're going to do 23% next 12 months. I think they'll do more. But assuming they're going to do 23%, based on that metric, how much am I paying for that growth? I'm paying a 0.31. So cheap-ish, but not the cheapest, right? HIMSS is a 0.10. Right? So not the cheapest, but cheap-ish, right? SMCI, for example, is a 0.2. And you can look at all of my spreadsheets and see NVIDIA is a 0.5 on this one. But I find NVIDIA very cheap compared to the potential, right? So cheap-ish. When the stock of SoFi gets really cheap is when you start envisioning a lot of growth in the coming years. So if I were to envision, say, 50% growth throughout 2025, which I think is entirely possible if rates drop and people rush to refinance everything, or they've postponed that wedding, or they've postponed that new car, and all of a sudden the rates have dropped and they're like, let me apply for a personal loan on SoFi to get that loan. If the growth in lending explodes to the upside because of a low interest rate, let's assume they were to grow at 50%, growing revenue at 50%. Then, if you assume that, you would have a stock that I would call dirt cheap at a 0.14, dirt cheap, especially given the potential in other areas, right? They earn a lot of fee revenues from referrals to other underwriters. They have an innovative stock platform where you can access IPOs, you can access the VC fund of Cathie Wood, which I've discussed in another video. They have a lot of very innovative parts. The one thing that I'm still a little bitter about is that they exited crypto. I'm still a little bit bitter about that. I think it's tough to claim to be a one-stop shop if you don't have the most asset that is wanted by Gen Z, but I'm willing to admit that you can buy an ETF on SoFi, that's for sure, but not all of the ETFs are available for all of the cryptocurrencies, like, Solana, for example, right? A lot of people want to own Solana, especially young people. Well, you can't buy Solana on SoFi. You got to have another platform. So anyways, if you're going to be a one-stop shop for Gen Z, I think they have a few things missing. I realize they didn't have a choice. I'm letting that go. But if they were to grow revenue at 50%, that would be really outstanding, and that would be a cheap stock. And if they grow at 30%, that would still be a somewhat cheap stock at a 0.24. So I'm not adding to SoFi. I have a full position. But wow, that stock was really a deal when it was trading at $6, wasn't it? Anyways, no investment advice, no financial advice, just entertainment. Hoping you were entertained. Please please subscribe. Follow me on Patreon, follow me on X if you can. Thanks for your time and have a wonderful day.